Welcome all the viewers. Dr. Vijay's lectures on accounting, lecture number 13, adjusting entries and reversal entries. In this lecture, we study in detail about adjusting entries, reversal entries and closing entries for outstanding expenses and prepaid expenses, incomes accrued but not received and incomes received in advance. Before going to the details of adjusting entries and closing entries, let us study something about final account. Final account is the last and final account in the ledger book of a firm for an accounting period. The balance standing in all the nominal accounts. After closing all the transactions for the period, the rectifying entries and adjusting entries are transferred to final account. As a result, all the nominal accounts get closed at the end of the accounting period. Only real accounts and personal accounts will show any balance which is carried forward to the next accounting period. So please understand, at the end of every accounting year, all the nominal accounts are closed by transferring their balances to final account. Only the balance of real accounts and personal accounts are brought forward to the next accounting period. So only those accounts, balance of those accounts will appear in the balance sheet. Now, final account of a firm may have different stages as manufacturing account, trading account, profit loss account and profit loss appropriation account. There will be different stages in final account, manufacturing account, trading account, profit loss appropriation account, etc. How many stages will there be in the final account of a firm depends on the form of organization of its ownership, where it is sole owner firm or partnership or company, and the nature of its business activity. See the table in the next slide. Look at this table. The first column is nature of ownership of the firm, second is nature of business activity, and 3, the stages required in the final account. A single owner firm doing some service activity, neither trading nor manufacturing, some repairs or some other service activity or some profession. It need have only profit loss account. Only one stage in its final account, only profit loss account. Now a single owner firm doing trading business, wholesale or retail, buying something and selling as it is. It has to prepare trading account and profit loss account, 2 stages in its final account. Now third, single owner firm doing manufacturing and trading. It is producing something and selling. Then it should have manufacturing account, trading account and profit loss account. Manufacturing account for finding out the cost of production for the accounting period, trading account for finding out gross profit and profit loss account for finding out net profit. Now comes partnership firm. In partnership firm, there are more than one owners. Each of them is called as partner. Say service undertaking. It is doing service undertaking. It need not have trading account or manufacturing account. Only profit loss account and profit loss appropriation account. Profit loss account is for finding out net profit and profit loss appropriation account for showing the distribution of profit among the partners. Now, a partnership firm doing trading business, wholesale or retail, it should have trading account, profit loss account and profit loss appropriation account. I will not explain, I think it is clear. Now, a partnership firm in manufacturing and trading, producing something and selling, it should have manufacturing account, trading account, profit loss account and profit loss appropriation account. Now, coming to joint stock companies, public or private. Joint stock companies means business corporations. In India, we call as companies. In Europe and America, they call it as corporations. Okay, service undertaking. Doing services, some service activity. Has to prepare profit loss account and profit loss appropriation account. In companies, its members are shareholders. Those who contribute capital are called shareholders or members. And this profit loss appropriation account is meant for showing the distribution of profit among the members and transfer of profits to different reserves, etc. Now, a joint stock company in trading business, doing wholesale or retail business. Then it has to have trading account, profit loss account, and profit loss appropriation account. Next, a joint stock company doing manufacturing and trading, producing something and selling. Then it should have manufacturing account, trading and profit loss account, and profit loss appropriation account. An institution, a trust, club, society, charitable organization, or non-profitable organization, it has to prepare income and expenditure account. Income and expenditure account is its final account. Slide 4 explains what is adjusting entry, closing entry, reversal entry, etc. Any posting, whatever done in the ledger book, should be supported by an entry in the journal book. This is a very important information. Whatever entry posting is shown in ledger book should be supported by an entry in any journal book. All entries other than those representing transactions are recorded in the journal proper or general journal. We know all transactions are recorded either in cash book if it is cash transaction, in day books if it is credit transaction regarding goods, and in journal proper for the other transactions. But non-transaction entries like rectifying entry, closing entry, adjusting entry, it can all be shown only in journal proper or general journal. Adjusting entries are entries passed at the end of the accounting year for adjusting omissions, accruals not paid or received, advance payments or receipts, depreciations and provisions. All these adjustments we have to make at the time of preparing final account. Only through these adjusting entries you can do it. Closing entries are passed for closing nominal accounts. We have seen at the end of the accounting period, after posting all adjusting entries, closing entries, etc., whatever affects the account, the balance standing in the nominal account should be closed by transferring to final account. All nominal accounts are closed at the end of the accounting period. Now, reversal entries are entries passed at the beginning of the subsequent accounting period for reversing the adjusting entries regarding expenses and incomes. Expenses prepaid and outstanding, incomes accrued and received in advance. Suppose you are preparing final accounts for a firm for the year of 2020. You have not paid salaries to your employees for the last month, December 2020. Then the salaries for December 2020 is an outstanding expenditure. For expense or revenue nature, which has fallen due but not paid, the adjusting entry is by debiting the concerned expenditure account and crediting the expenditure outstanding account. At Sabu's firm, we know salaries for the month of January 2020 are not paid, and so it is not recorded in the books. It is $12,000. We are preparing final accounts on 31st January 2020 for the month of January. The entry needed is salaries account debtor to outstanding salaries account $12,000. A new account, outstanding salaries account, is created and it gets credit posting. Its balance is carried forward to the next period. It is a liability of the firm. At the beginning of the next accounting period, the entry is reversed, resulting in outstanding salaries account getting closed and salaries account getting credit. When the salaries due is paid in the next period, it will be debited in salaries account, setting off the credit given through the reversal entry. Adjusting entries for expenses prepaid. In the case of expense or revenue nature, if any part of it which is paid relates to the period beyond accounting period, that prepaid portion should be cut off by crediting the expenditure account and debiting the prepaid expense account, because only the current period's expenditure can be transferred to profit loss account. In the case of Sabu, local taxes paid $2,000 is for 6 months from 1st January to 31st June 2020. While closing accounts on 31st January 2020, taxes proportionate for 5 months is prepaid. It is to be transferred to taxes prepaid account, because we are preparing final accounts only for the month of January 2020. The entry is taxes prepaid account debtor to local tax account 1667. 1/5 of $2,000. Taxes which is debited, taxes account, which is debited with $2,000 gets credit for 1,667, and so the remaining 333, which relates to the month of January, only remains in that account, and that only will go to profit loss account. Taxes prepaid account is carried forward to next period. It is an asset. While opening the books on 1st January, the adjusting entry which is done will be reversed. That is, it will become local tax account debted to taxes prepaid 1,667. As a result, in the local tax account of the subsequent period, the taxes which are already paid in the previous period will get debited. Adjusting entry for incomes accrued but not received. Accrued but not received means it has fallen due but is not actually received. For incomes of revenue nature, accrued but not received, the income account should be credited and the income accrued but not received account to be debited, or the party to be debited. At Sabu's firm, commission is received from Meadows for purchase of goods from them at 2% of invoice price. But the total commission receivable for the year will be calculated only at the end of the year and given at that time only, as per the agreement. The amount receivable for January purchase, $32,000, is $640. It should be shown as income in the profit loss account prepared for the month of January. So, the adjusting entry required is commission due from Meadows account debtor to commission income account. Commission income account gets credit because it is income for the period. Commission due from Meadows account gets debit because it is an asset, something receivable from some other parties or asset. It should be carried forward to the subsequent period and shown in the balance sheet as asset. In the subsequent period beginning, this can be closed through a reverse entry. The reverse entry will be commission income account debted to commission due from Meadows account. Commission due from Meadows account will close and commission account will get a debit. Where the commission is actually received, commission account will get credit and that will set off the debit given. Adjusting entries for incomes received in advance. With this slide 8, this lecture comes to an end. Please subscribe if you have not subscribed my lecture so far. Your comments are highly appreciated. Please share maximum to your friends and connections who will be benefited by this lecture. Where an item of income late in the period beyond accounting period is received in advance, that income received in advance is a liability and should be transferred from income account to income received in advance account by debiting the income account and crediting income received in advance account. The income received in advance will be carried forward to next period's book. Reversal entry can be passed at the beginning of the next accounting period for bringing back the income received in advance to income account. No such item of income is there at Sabu's firm for month of January. Assume the firm gets rent for a portion of shop building let out, $3,600 per annum. It is received in advance on 1st January. Then, of the $3,600 received, that for 11 months, that is $3,300, belong to the period after 31st January. That cannot be shown as income in the profit loss account for 31st January. It should be transferred to rent received in advance account and reverse entry passed in the subsequent period. Thank you for your participation till the end. The lecture concludes.